If you have a 401k plan, you probably already know that you can borrow money from it. But what most people do not know is that there is one specific exception buried inside the IRS rules that changes everything about how and when you have to pay that money back. This is not a loophole. This is not a trick. This is an official rule written into the Internal Revenue Code, and it could be the difference between managing your loan comfortably or getting hit with taxes and penalties you never expected. Today, we are going to break down exactly what this exception is, how it works, who qualifies for it, and what happens if you ignore it. If you have ever considered taking a loan from your 401k, or if you already have one right now, this information is directly relevant to your financial future. Welcome to Federal Benefit Guide. I am here to walk you through the rules, the exceptions, and the real-world impact, all based on official IRS guidance, so you can make informed decisions about your retirement savings. Let us start with the basics. Under IRS rules, when you take a loan from your 401k plan, you generally have to repay it within 5 years. That is the standard rule. The IRS requires that you make payments at least quarterly, and the payments must include both principal and interest. This 5-year clock starts ticking from the day you receive the loan. But here is where the exception comes in. The IRS explicitly states that there is an exception to this 5-year requirement. If you use the loan to purchase what the IRS calls a primary residence, the 5-year repayment period does not apply. That means you may be able to repay the loan over a period longer than 5 years. This is stated directly on the IRS website, under their Retirement Topics page on plan loans. The exact language says, and I quote, "The law provides an exception to the 5-year requirement if the employee uses the loan to purchase a primary residence." Now, let us be clear about what this means. It does not mean you never have to pay the loan back. It means the repayment timeline can be extended beyond the standard 5 years. Your plan administrator determines the specific terms, but the IRS allows this extended repayment window specifically for home purchases. This is the one exception that most 401k participants are never told about. And it matters because buying a home is one of the biggest financial decisions you will ever make. Having flexibility on your repayment timeline can make a significant difference in your monthly budget and your long-term financial planning. All of the information I am sharing with you today comes directly from the Internal Revenue Service, which is the federal agency that oversees 401k plans and enforces the rules around them. The specific pages I am referencing include the IRS Retirement Topics page on plan loans, the IRS Retirement Plans FAQs regarding loans, and the IRS page titled Considering a Loan from Your 401k Plan. These are official government sources. They are not opinions, not interpretations from financial bloggers, and not secondhand summaries. These are the actual rules as published by the agency that has authority over retirement plan regulations. The IRS also references the Internal Revenue Code, specifically Section 72P, which is the section of federal law that governs plan loans. When the IRS says there is an exception to the 5-year rule for primary residence purchases, they are pointing to this specific section of the law. In addition to the IRS sources, I will also reference provisions from the Secure 2.0 Act, which was signed into law in late 2022 and introduced several new changes to retirement plan rules. The IRS has published guidance on its website about these Secure 2.0 provisions, and we will cover the ones that relate to loans and withdrawals. I want to be transparent with you. Some of the details I will discuss, such as how individual plans implement these rules, can vary from one employer to another. The IRS sets the federal framework, but your specific 401k plan may have its own additional rules or restrictions. Always check with your plan administrator for the exact terms that apply to your situation. To really understand why this exception matters, you need to understand how 401k loans work in the first place. So let me give you the full picture. A 401k loan is exactly what it sounds like. You are borrowing money from your own retirement account. The IRS allows qualified plans, including 401k plans, 403b plans, and certain other employer-sponsored retirement plans to offer loans to participants. However, the IRS does not require plans to offer loans. It is optional. Your employer decides whether to include a loan provision in your plan. If your plan does allow loans, there are strict federal limits on how much you can borrow. According to the IRS, the maximum amount you can take as a loan is the lesser of two numbers. The first is 50% of your vested account balance. The second is $50,000. Whichever of those two numbers is smaller, that is your maximum loan amount. Let me give you an example straight from the IRS. If your vested account balance is $80,000, 50% of that is $40,000. Since $40,000 is less than $50,000, your maximum loan would be $40,000. Now there is a secondary exception here that is also important. The IRS says that if 50% of your vested balance is less than $10,000, you may be allowed to borrow up to $10,000 instead. This is designed to help people with smaller account balances still access loan funds. However, plans are not required to include this exception. It is optional. One more important point about IRAs. The IRS is very clear on this. You cannot take a loan from an IRA. Not a traditional IRA, not a Roth IRA, not a SEP IRA, not a simple IRA. If you try to borrow from an IRA, the entire account could be disqualified, and the full value could be included in your taxable income. Loans are only available from qualified employer-sponsored plans, like 401ks. So that is the framework. You can borrow up to 50% of your vested balance, or $50,000, whichever is less. You generally have 5 years to repay, and you must make payments at least quarterly. Now, against that backdrop, the primary residence exception becomes much more meaningful. When you are buying a home, the amount you might need from your 401k could be substantial. And the 5-year repayment window on a large loan can create significant monthly payment pressure. The exception allows for an extended repayment period, which can ease that pressure considerably. Let us go deeper into how this primary residence exception actually works in practice. First, the loan must be used specifically to purchase a primary residence. The IRS uses the term primary residence, which generally means the home where you will live as your main home. This is not for investment properties, not for vacation homes, not for rental properties. It is specifically for the home you intend to live in. Second, the extended repayment period is not unlimited. The IRS allows the repayment to go beyond 5 years, but your plan sets the actual terms. Some plans may allow 10 years, 15 years, or another period that aligns with the home purchase. You need to check with your plan administrator to find out exactly what repayment period your plan allows for primary residence loans. Third, this exception applies specifically to the repayment timeline. It does not change the maximum loan amount. You are still subject to the same 50% or $50,000 limit, whichever is less. The exception only affects how long you have to pay the money back. Fourth, the interest you pay on a 401k loan goes back into your own account. You are essentially paying interest to yourself. This is one of the features that makes 401k loans different from traditional bank loans. However, the interest is paid with after-tax dollars. And when you eventually withdraw that money in retirement, it will be taxed again. So there is a double taxation element on the interest portion that you should be aware of. Fifth, even with the extended repayment period, you still must make regular payments. The IRS requires substantially equal payments that include both principal and interest, paid at least quarterly. You cannot simply skip payments because you have a longer repayment window. Now, here is something else that is important to understand. Not all plans offer the primary residence exception. The IRS allows it, but your employer's plan must specifically include it in its plan documents. If your plan does not offer this option, you will be subject to the standard 5-year repayment, regardless of how you use the loan money. This is why it is so important to read your summary plan description. That is the document your plan administrator provides that explains all the rules of your specific plan, including whether primary residence loans are available and what repayment terms apply. While the primary residence exception is the most significant one, there are several other exceptions and special provisions in the IRS rules that you should be aware of. Let me walk through each one. The first is the military service exception. If you are an employee who serves in the armed forces, your employer may suspend your loan repayments during your period of active duty. When you return, the repayment period is extended by the length of time you were on active duty. This means your repayment schedule shifts, but you do not lose any time. The IRS specifically mentions this provision on its plan loans page. The second is the leave of absence exception. If you take a leave of absence from your employer and your salary is reduced to the point where you cannot make loan payments, your employer may suspend repayments for up to 1 year. However, there is an important difference from the military exception. When you return from leave, the repayment period is not extended. You have to make up the missed payments either by increasing your regular payment amounts or by making a lump sum payment at the end. The total loan term cannot exceed the original 5-year period. The third is the plan loan offset rollover exception. This one was changed by the Tax Cuts and Jobs Act, effective January 1st, 2018. If you leave your job and your loan goes into default, your account balance is reduced or offset by the unpaid loan amount. Previously, you had 60 days to roll that offset amount into another retirement plan to avoid taxes. But under the new rule, if the offset is due to plan termination or separation from employment, you now have until the due date of your federal tax return, including extensions, for the year in which the offset occurs. That gives you significantly more time to roll the money over and avoid the tax hit. The fourth set of exceptions comes from the Secure 2.0 Act. This law introduced new provisions for emergency expense withdrawals. Under Section 115 of the Act, participants can take one self-certified, penalty-free withdrawal of up to $1,000 per calendar year for personal or family emergency expenses. While this is technically a withdrawal and not a loan, it is relevant because it provides another way to access retirement funds without the 10% early withdrawal penalty. You also have the option to repay the withdrawal within 3 years. The Secure 2.0 Act also created emergency savings accounts within retirement plans. Participants can withdraw their entire emergency savings account balance, which is capped at $2,500 without penalty. Again, this is a withdrawal, not a loan, but it is part of the broader landscape of exceptions to retirement plan penalty rules. The fifth exception relates to disaster relief. The IRS has historically provided special loan rules for participants affected by major disasters. For example, after Hurricanes Harvey, Irma, and Maria, the maximum loan amount was temporarily increased to the lesser of $100,000 or 100% of the participant's account balance. Repayments could also be suspended for 1 year for affected individuals. Under Secure 2.0, similar disaster relief provisions can be activated for future federally declared disasters. Now I need to talk about what happens when things go wrong. This is where the consequences become serious, and it is why understanding the exceptions is so important. If you do not repay your 401k loan according to its terms, the IRS treats the outstanding balance as a deemed distribution. That means the unpaid amount is considered a withdrawal from your account, and it becomes taxable as ordinary income in the year the default occurs. The IRS provides a specific timeline for when a default is triggered. A plan may provide that a loan does not become a deemed distribution until the end of the calendar quarter following the quarter in which the repayment was missed. For example, if your quarterly payments are due in March, June, September, and December, and you make the March payment but miss the June payment, the loan would be in default at the end of June, and it would be treated as a distribution at the end of September. Once the loan is treated as a distribution, you face 2 potential tax consequences. First, you must include the previously untaxed amount in your gross income for that year. This could push you into a higher tax bracket and significantly increase your tax bill. Second, if you are under age 59 and a half, you may have to pay an additional 10% early distribution tax on top of the regular income tax. There are exceptions to the 10% penalty. The IRS lists several on its website, including being at least age 59 and a half, certain medical expenses, certain disability situations, and others. But if none of those exceptions apply to your situation, the 10% penalty adds to the financial damage. One more critical point. The biggest cause of 401k loan defaults is leaving your job. When you leave your employer, whether voluntarily or involuntarily, many plans require you to repay the full outstanding balance of your loan. The time frame is typically 60 to 90 days. If you cannot come up with that money, the loan defaults and is treated as a taxable distribution. This is why the plan loan offset rollover exception I mentioned earlier is so important. If you leave your job with an outstanding loan balance and cannot repay it, you may have until your tax filing deadline, including extensions, to roll the offset amount into another retirement account and avoid the tax consequences. This can give you months, rather than weeks, to figure out a solution. Let us now talk about who this affects and what the real-world impact looks like. First, let me address the confirmed direct impacts based on the IRS rules. For anyone considering using a 401k loan to help buy a home, the primary residence exception provides a confirmed official pathway to extend your repayment beyond 5 years. This is not speculation. This is written into the Internal Revenue Code. The direct impact is that your monthly payments could be lower than they would be under a 5-year repayment schedule, because the same loan amount is spread over a longer period. For military service members, the confirmed impact is that your loan repayments can be paused during active duty without penalty, and your repayment timeline is extended by the duration of your service. This is a direct federal protection. For employees who take a leave of absence, the confirmed impact is that you may get up to 1 year of payment suspension, though you will need to make up those payments within the original loan term. For anyone who leaves their job with an outstanding loan, the confirmed impact is that you may have until your tax filing deadline to roll the offset amount into another retirement account, thanks to the rule change that took effect in 2018. Now, let me address the possible and indirect impacts, which are based on analysis rather than direct IRS statements. The first possible impact is on your retirement savings. When you take money out of your 401k as a loan, that money is no longer invested in the market. Even though you are paying it back with interest, You may miss out on investment growth during the period the money is out of your account. If the market performs well during that time, the opportunity cost could be significant. This is not something the IRS rules address directly, but it is a real financial consideration. The second possible impact relates to the double taxation of interest. You contribute to your 401k with pre-tax dollars. When you take a loan, you repay it with after-tax dollars. Then, when you withdraw that money in retirement, it is taxed again. The interest portion of your repayment is effectively taxed twice. This is an inherent feature of 401k loans that financial advisors often point out. The third possible impact is the risk of job loss. If you have an outstanding 401k loan and you lose your job unexpectedly, you could find yourself facing a large tax bill if you cannot repay the loan within the required time frame. The rollover exception helps, but you still need to come up with the money to roll over. If your financial situation is already strained due to job loss, this can create additional pressure. The fourth possible impact is on your credit score. There is actually some good news here. According to Fidelity, 401k loan defaults are not reported to credit bureaus, so a default will not directly damage your credit score. However, the tax consequences can still be severe, and the reduction in your retirement savings is permanent unless you are able to roll the money over. The fifth possible impact is behavioral. Having access to your retirement funds through a loan can create a temptation to use retirement savings for non-essential purposes. The IRS specifically notes on its website that you should consult with a financial planner before taking a loan from your retirement account to determine whether this is the best option or whether you would be better off obtaining a loan from a financial institution or other sources. Let me share some practical points that the IRS and other official sources highlight. First, check whether your plan even offers loans. The IRS makes it clear that plan sponsors are not required to include loan provisions. You can find this information in your summary plan description or by contacting your plan administrator directly. Second, understand that the primary residence exception is plan-specific. Even though the IRS allows it, your plan must include it in its documents. Do not assume it is available. Ask your plan administrator specifically whether primary residence loans are offered and what repayment terms apply. Third, consider the total cost of the loan. A 401k loan may seem free because you are paying interest to yourself, but there are opportunity costs, potential fees from your plan administrator, and the double taxation of interest to consider. Fourth, think about your job stability. If there is any chance you might change jobs in the near future, a 401k loan carries additional risk because of the repayment on separation requirement. Make sure you understand what happens to your loan if you leave your employer. Fifth, be aware of the rules around multiple loans. The IRS allows participants to have more than one outstanding loan at a time, but the total of all loans cannot exceed the maximum amount. The calculation for a second loan involves looking at your highest outstanding loan balance in the preceding 12 months. This can get complicated, so talk to your plan administrator if you are considering a second loan. Sixth, understand the difference between a loan and a hardship withdrawal. A loan must be repaid. A hardship withdrawal does not need to be repaid, but it permanently reduces your account balance and may be subject to taxes and penalties. The IRS treats these as two completely different things with different rules. Seventh, the Secure 2.0 Act provisions are still being implemented. Some provisions took effect immediately, while others phase in over several years. If you are interested in the emergency expense withdrawal or the emergency savings account options, check with your plan administrator to see whether your plan has adopted these provisions yet. Not all plans are required to offer them. The third misconception is that the 5-year repayment rule is absolute. As we have discussed, the primary residence exception allows for a longer repayment period, and the military service and leave of absence provisions allow for temporary suspensions. The 5-year rule is the default, but it is not the only option. The fourth misconception is that defaulting on a 401k loan will ruin your credit. As Fidelity notes, 401k loan defaults are not reported to credit bureaus. The consequences are tax-related, not credit-related. However, the tax consequences can still be serious. The fifth misconception is that 401k loans are always a bad idea. This is an oversimplification. In certain situations, such as when the alternative is high-interest credit card debt, or when you need funds for a primary residence purchase, a 401k loan can be a reasonable option. The IRS itself does not prohibit these loans. They simply require that you understand the rules and follow them. If you are watching this video and thinking about taking a 401k loan, here are the steps I recommend based on the official guidance available. Step 1. Contact your plan administrator and ask whether your plan offers loans. Not all plans do. If yours does not, this entire conversation is academic for your situation. Step 2. Ask specifically whether your plan offers the primary residence loan exception. If it does, find out what repayment terms are available. This could significantly affect your decision if you are buying a home. Step 3. Read your summary plan description. This document contains all the specific rules for your plan, including loan limits, repayment terms, default provisions, and what happens if you leave your job. Step 4. Calculate the total cost of the loan, including the opportunity cost of money not invested in the market, any administrative fees, and the tax implications of paying interest with after-tax dollars. Step 5. Consider alternatives. The IRS itself recommends consulting with a financial planner to determine whether a 401k loan is your best option, or whether a traditional loan from a financial institution would serve you better. Step 6. If you already have a 401k loan and you are thinking about changing jobs, talk to your plan administrator about your options. Understand the timeline for repayment and whether you can roll the offset amount into another retirement account if needed. Step 7. If you are a military service member, make sure your employer knows about your service so they can apply the repayment suspension if your plan allows it. Step 8. Stay informed about Secure 2.0 provisions. New rules are still being phased in, and your plan may adopt new options in the coming months and years that could be relevant to your situation. What you should take away from this is that 401k loans are not a one-size-fits-all product. The rules have built-in exceptions that can significantly affect your repayment obligations. But these exceptions are only useful if you know they exist and if your plan offers them. Always check with your plan administrator before making any decisions. If this information was helpful to you, please subscribe to Federal Benefit Guide. We break down complex federal benefit and retirement rules into plain language so you can make informed decisions about your financial future. Hit the subscribe button, turn on notifications so you do not miss our next video, and if you have questions about your specific situation, drop them in the comments below. And as always, the information in this video is for educational purposes, based on official IRS guidance. It is not tax advice or financial advice for your individual situation. For personalized guidance, consult with a qualified financial advisor or tax professional who can look at your specific circumstances. Thank you for watching Federal Benefit Guide. I will see you in the next video.